If you set up your structure wrong for property investment, it could end up costing tens of thousands of dollars, and in some cases, hundreds of thousands of dollars. As an accountant for over 17 years, running my own award-winning accounting practice and serving thousands of clients during this time, the one thing a lot of property investors don't realize until it's too late is that choosing the wrong structures is extremely expensive and very hard to change. In fact, it can cost double the amount and include income tax, stamp duty, legal fees, and maybe even marketing and sales fees if you plan to sell the property back onto the open market. So in this video, I'll share with you an exclusive training that I did with my clients where I taught them how to choose the right structure for your property investment to maximize tax benefits, protect their assets, and avoid extremely costly mistakes down the line. By the end, you'll understand how to make informed decisions that will best suit your financial goals, regardless of whether you're a first-time property investor or building your property portfolio. Let's dive in. So this topic, again, just wanted to mention, is tax and structuring for property investments. It's actually really important for you to get the advice before you make the purchase. A common question that people ask is, when do you get the advice? I usually say, within a week or a month before you make the purchase, or before you start looking, you should go and get some tax advice and legal advice as well. A lot of people that purchase a investment property, they always look at okay, well, what is the future situation or future circumstance? And what I mean by that is people just go, all right, well, I'm buying this property for one day I'm going to sell, or for one day my retirement. They consider the tax situation from when they retire, but they don't actually consider the tax situation of how they got the money to buy it, how they're going to get the money to pay for the property and the loan. They only just consider, okay, well, if I ever sell it one day, I want to get the 12-month 50% discount. I want to get the lowest tax possible when I sell one day. That could be 10, 15 years down the track. So you shouldn't really base your decision just solely on the exit strategy. You should base it on the current tax situation, not just the future tax. And I'll go into more detail later, but I find that a lot of accountants and business owners and clients, the poor decision on purchasing a property and structuring it in a way for the future exit strategy, and not taking consideration the current tax situation and the issues that arises when you have to pay for the property and get the loan. That's a big mistake that people don't really consider. And to be honest, I think it's partly because, there's some people out there that are giving poor advice and they just don't know any better. The next things I want to kind of also go about is explain to you the different types of taxes that you have to consider. So the first one is obviously income tax. Income tax is 25% in a company. It ranges for individuals. So you can go anywhere between 0% in your personal name all the way to 45%. And sometimes people say it's like 50%. And the reason being is because it's 45% plus Medicare of 2%. So it's 47%. And then you might have like HEX or some other extra taxes because you're a high income earner, and it kind of pushes you very close to 50%. So that's why I'm saying that as an individual, it can range from anywhere between 0 to 47% in taxes. And then your company is 25%. And in a trust, it depends on who the beneficiary is and how much you can distribute the profits to that beneficiary and what tax they are on. There's also capital gains tax. Capital gains tax is quite similar to income tax. It's just a tax on investments, and they call it something different. So because there's different concessions that you can apply when it comes to investments, like the 50% discount where you own the property or invest for more than 12 months and then you sell it, your tax can get halved. And that's how that works. And also you can get exemptions. So if you own the property and you lived in it and then moved out and then sold it within a year, you can argue that that's your main residence and you can exempt the whole property as well. I did do a video about that recently on YouTube, so you can check that out if you want. There's also land tax. So people sometimes don't even know what land tax is. So land tax is not council rates. Land tax is not income tax. Land tax is actually a tax that gets charged by Revenue New South Wales or any of the different states that your property is in. And it's actually, depending on the state,
they charge a different rate. And it's actually quite annoying because every bloody state has different rules. They're all quite similar, but they're not all the same, which is annoying. But basically, in New South Wales, it's basically 1.6% of the land value over the threshold. So let me just do a quick calculation on what that means. Let's just say that your property is worth $1 million in land value. No, actually, let's not do $1 million. Let's do something bigger because the land values, the land tax free threshold is higher. But basically, it's the formula is $1.5 million land value minus the threshold. So the threshold is 1075. So you got 425. So that's the threshold here, times by 0.16. And that's 6,800 plus 100. So that's the formula. So on an investment property that has a land value of 1.5 mil, you will pay annually $6,900 to the state government. That's how land tax works. Okay, you can easily work that out with a land tax calculator as well. That's online. Depending on different state, you can actually jump onto that website to calculate like that. So this is not to be confused with income tax or anything like that. But a lot of people actually don't take that in consideration because they don't realize that they have to pay land tax. And the reason being is because when you purchase your first property, it could be your main residence, so it's exempt from land tax. But when you purchase your second property and it's an investment property, it could be under $1 million in land value, then you don't have to pay land tax. It's the second property that you have to pay land tax. And the rules are the Office of State Revenue doesn't come to you to tell you to pay land tax. You're actually supposed to self-assess and let a Revenue New South Wales know that you have to pay land tax. It's a bit ridiculous. Like, how do you even know? First time property investor, don't even know about land tax. And then how, for some weird reason, you have to kind of register and tell them that you have to pay for it. And then once you register, even though they should know already because, you know, you paid stamp duty before. But yeah, that's just what happens. That's why a lot of people don't know about land tax. And if you don't pay land tax and you think you've gotten away with it, fat chance what happens is after 5 years or whatever it is, they will probably audit you. Or when you sell the property one day, they will just calculate the total amount of land tax that you're supposed to pay and deduct that off you, or make you pay it before they allow you to sell the property. So that's how land tax hits you pretty hard, and sometimes people don't know about it. Okay, and the last thing, tax that you might need to be aware of, well, actually, there's two other things. The stamp duty as well. It's all, stamp duty is technically a tax, but that's when you transfer property over. All right, and then the last thing is GST, goods and services tax. So when does goods and services tax get involved when it comes to property investments? Only if you are considered a property developer. And a property developer is someone that, knocks down, rebuilds a property. I won't go into too much detail about that, but these are like businesses that knock down and rebuild properties and sell it for a profit. So that's what you're supposed to do. If you knock down, rebuild a property and rent it out and not planning to sell it, then you're not really a property developer. You don't need to worry about GST. It's only when you buy a property for the intention of knocking down, rebuilding, and then selling, then that's when you're considered a property developer. And that's when you're considered a business owner. And as a result, you have to pay GST, which is 10% GST on the sale price. And that gets really, really complicated. And if that happens, speak to an accountant. If you don't, you might be up for a lot of taxes. All right. Next thing is my beautiful spreadsheet I did for you yesterday, which I stayed up and did. Looks great, eh? So there are 4 different types of structures for property investment. First one is to buy in your individual name. Second one is to buy in the company. Third one is to buy in the trust. Or the fourth one is SMSF. All right. I think most of you know about this already. And if you don't know, watch my videos online. But I'll just quickly explain the benefits and pros and cons of each one, and also, the cost. So individual doesn't cost you any money. All right. There's no cost to, set up an individual because it's in your personal name. You exist already. You've got a tax file number, so you can just buy in your personal name. All right. It's cheap. It's simple. If the property makes rental losses, you can claim it against your income. That's what you call negative gearing. Labor government might come in and try to restrict that one day, I'm all for it. But if it does happen, that means that negative gearing might not be a pro anymore to buy in your personal name. The tax rates in your personal name can be quite high. So if it's profitable and the rental income is high and you make money from the rental profits, that means that your tax could be all the way up to 47% if your income is high. So it really depends on how much money you actually make. So if you've retired and you're thinking of living on your investments, then it actually might be a good idea to buy in your personal name because you have no other income and, your tax rate is small. However, if you're earning income, like pretty much every Australian to live in Australia right now, your tax could be quite high. And as a result, it could impact you negatively because then you're paying 47% tax on every rental dollar that you're making, which is a lot of money. There's also limited benefits in terms of so that's the tax benefits, but limited benefits in asset protection. So if you get sued because of the property investment, or if you get sued in your personal dealings, they can go after your assets, and those assets could be the property that you own, and it could be any of your personal assets. So it's actually quite risky. You're putting everything in under one name, and if they go after it, they can go after all your assets, and it's all your dealings as well. And the reason why accountants and lawyers talk about asset protection and separating your responsibilities, and then splitting your risk away from you so you don't get sued is but that's why you set up different entities to house the property or investments. It's not always all in your personal name. Okay, great thing about being an individual is you get a 50% discount on the purchase, which is they call it CGT discount. So if you purchased a property for say 500K and then sold it for $1 million, you made a 500K profit, you'll pay tax on that. But you don't pay 500K tax. You just pay a percentage of your income tax rate, depending on what tax rate you're sitting on. Say you're on the highest tax rate, it's 235, but because you got the CGT discount, that halves. So you only pay tax on 117K on that 500K profit that you made. That's how that works. So what is your effective tax rate then? It's 50% of your 47. So it's like 23.5. That's how that works. So it's actually quite a good structure if you're planning to sell. Okay, one thing they don't talk about, most accountants don't talk about, is Division 7A problems. And I think if you were in my deep dive two weeks ago or 3 weeks ago, we talked about Division 7A problems. And why is there a problem if you're an individual? Like why do you have Division 7A problems? And the reason why I raise this is in order for you to buy the property, you need to put down a deposit, you need to put down money, and you also need to make repayments on a loan to pay for that property. And no one talks about this. And I find it weird that no one talks about it. But in order for you to get that money, you need to draw that money out of your business. And as a result, your business is most likely in the company. It's paying 25% of tax. So when you take that money out, you have to pay a top-up tax. And that top-up tax is most likely that 47% that we're talking about. So no one takes that in consideration that when you draw the 250K or 300K out of your company, that you're going to have Division 7A issues. And that's where I think as an individual, it's a con. If you buy in your personal name and you're taking money from your company to do that, to pay for the deposit, there is a Division 7A issue where you need to pay the top-up tax. If you hold it in another entity, you may not have that situation. And that's actually a benefit. So that's where I bring in a company. So a lot of, not a lot, but some accountants out there don't prefer investing in a company. They prefer investing in a trust. And the reason why they say a trust is better is because asset protection, the ability to, use the CGT discount because you get the 50% discount, because whereas a company doesn't get the 50% discount. But the great thing about a trust is also you get to split your income. Everyone hears that. So I'm not going to go into too much detail. You get to distribute your profits to other beneficiaries that have maybe a lower income. Right? what a lot of people don't mention is a company doesn't have Division 7A issues. Okay, if you were in my deep dive a few weeks ago, I mentioned that when you lend money from a company to another company, there is no Division 7A issues. There's no top up tax because both companies have the same tax rate. So the great thing about investing using a company is that you don't need to, if you were going to draw $250,000 out of the company, pay the extra top up tax of say, 25% or 20%. But let's just say 25 because remember how I mentioned to you, if you were to take the money out of the company, take the money and put it in your personal name, you pay the 47%. It's roughly about 50%. So I'm going to round it up to 50%. So your company is already only pay 25%. So you need to pay an extra 25. So the leftover money you get from that 250K in order for you to invest is 187K. Whereas if you were to invest using a company, you don't need 100, like you don't get 187K. You have 250K to invest. It's a lot more money to invest. And I think that there is very crucial on why I actually think that investing in a company is a kind of sometimes in your situation, depending on the situation, a superior structure than investing in a trust or in your personal name. Okay. So no Division 7A issues is one of the key benefits of investing in a company. The one thing a trading company costs is $1,200 to set up, and a trust there's a bit more. It's a bit more expensive because you're setting up a trust as well as a trustee company, so it's $2,500. Both of them help you increase your borrowings. Okay, this is something that you hear online a lot. Mm, I don't actually agree with it, but there is some, you know, influencer or mortgage broker out there that say if you invest using a trust or a company, you have unlimited borrowing capacity. And what that means is that you some banks out there, only certain banks have a policy out there that would lend money to a trust using your income and using like the overall income of the group. And then as long as for your next investment, as long as your trust or the investment vehicle or the company that you that owns the property can service its loans and it's profitable, they can exclude that that investment and the loans in that investment out of the picture, and so you can borrow again using your own income again. So you just need an accountant's letter to write to the bank, and the bank will just ignore the loan commitments that you have on that property. So you can then pretty much borrow again using like the other income that you earn in your business and in your personal name, and you can borrow again. So that's why some people say that if you invest using like a company or a family trust, you can increase your borrowings. Whereas if you invest in your personal name, they look at all your properties and they don't exclude any of your loan commitments out because they look at, all right, well, how much income do you have? How much liabilities you have? What are your expenses? They look at everything here, anything related to you. Whereas they're looking at the trading company, they can just isolate the trading company separately and ignore the individuals and other, entities. So that's where you can actually sometimes increase your borrowing capacity by using a special purpose vehicle like a trading company or family trust. Okay, the last structure is SMSF. SMSF is basically similar to a family trust. The only difference is it's for your retirement and there are special rules. And so the tax rate for SMSF is 15%. And if you hold the asset for more than 12 months, if you ever sell it one day, you get a 10% capital gains tax rather than 15% tax, which is great. The only thing is that you can't own property that you currently live in or your family lives in. It's like basically you can't have in-house assets, they call it. So family members can't live in the house. It has to be rented out. And it's costly to set up, 2,500, and it's costly to run as well. So that's the differences.
Hey, quick question in regard to in the picture, right? So you say mentioned the individual and the trust, family trust, right? But let's say if I buy the investment property with me and my wife, so the land tax will be divided by each individual, and also the capital gain, the GGT discount will be divided by both. Compare to the family trust, same thing like if I put the family trust between me and my wife, and same thing if I buy the property to the family trust, which one give me the more benefit?
I knew these questions are going to start coming out. They're already coming out. Okay, good. Let's answer it. So there are land tax issues in the family trust. Okay, I'll answer your question, but let me first explain this because I completely forgot to explain it, even though it was in front of me. But in certain states, if you invest in a property using a family trust, there could be land tax issues. And the reason being is because a special trust doesn't receive land tax threshold. What does that mean? When I did the calculation before, when I looked at the land tax in New South Wales, let me just go back to this table. So on a $1.5 million property, if you owned it in your family trust, you would have paid 107,513 minus times 0.16. You would have paid about $6,800 in land tax if you owned it in your personal name, okay? Because you get the threshold. But if you owned it in the family trust, you don't get the threshold anymore. So the 1.5 mil, the formula is 1.5 mil times, so 24 grand. Okay. I'm not sure if you...
So is that the rate land tax from the individual and then family just different, right? Different rate, right?
Yes, yeah. So basically in the individual name, you get the threshold. The formula is there. The formula is there for you, and then you can apply the threshold for you. That's if you don't own any other properties and you've used it up. So it's not per property that you get a threshold. It's total properties that you owned, firstly excluding your main residence, and then you get to apply the threshold onto all the assets, investment properties that you have, and the land value, not the building cost, the land value. And if you want to work out the land value, there's something that you can Google that, like land value, New South Wales, and then like you can search for it, and it will tell you roughly what the land value is. If you were to purchase it in a family trust, you're not allowed to claim the threshold, so they tax you 24 grand instead. And it's not 24 grand once off, it's per year. So instead of you paying 6,900, now you're paying an extra 24 grand times 6,900. It's like about extra 17 grand extra on top. So a lot of people make that mistake, and they come to me after and they go, hey, Davey, I've got a huge land tax bill every year. Yes, I get to distribute my profits, but the interest rates are so high now, so I'm actually not even making any profits. But I'm paying land tax of 24 grand a year. What do I do? And I'm like, well, what can you do? Because if you were to sell the property back into your name, you have to pay stamp duty again. So do you want to sell your property? And some clients prefer to sell the property again. So they happy to pay double stamp duty, which could be like 60 grand worth of stamp duty, just to remove it back out of their name, into their personal name or into a SMSF or into a company, because they can get their land tax free threshold. So pretty scary. So does that answer your question? No, it doesn't. That was just one point. All right. So I have to come back to you as a accountant and then ask you, what are your intentions first? Like, what are your goals of this property? How much is it worth? What's your plan with it? Do you want to sell it one day? Do you want to keep it? Do you want to rent it? Do you want to knock it down, rebuild? They are the questions I have to ask you first before I give you the advice on which structure is better. Okay, so let me give you an example before you tell me your situation. But if you say to me that you just want it and you want to rent it out, and then you want to keep it forever, you don't want to sell it, then and you don't have any other investment properties yet, and the property itself is in New South Wales, then buying in a family trust may not be a good idea. The reason being is, one, you've got land tax issues, because you buy in a family trust, then you need to pay the extra top up, not top up, the extra land tax, because you don't get the threshold. And in your individual name, you don't actually have any properties that take up the land tax free threshold. So it's best to buy in your personal name. Then the question I will ask you is, does your wife make any income? What's the difference between your income and your wife's income? Because if your wife's income is lower, then maybe it's better to buy in her name solely. Okay? There's a reason why, because of that. It's because your tax rate is maybe at 47%, and there's no point like getting the rental income in your name. And if you sell it one day, you would pay the 47%, even if you get the 50% discount, you would still pay a higher tax bracket, whereas your wife may not be earning any income, so her income's low, so she could access like a lower tax rate. Obviously, in a portion of the profits she makes. And also, a great thing about this, and I know about your situation, you're a business owner. You take risk, people can sue you. And so having property in your name is risky and it's not good for asset protection. So that's another reason why that it might be better under your wife's name. Okay. But then you have to ask the question, can your broker or the bank give you a loan based and purchase it under your wife's name rather in your name, and can you still be can they still use your income to support the loan? In certain banks, they allow that. Does that answer your question, or do you need to provide me more information about your situation?
Thanks for that. But you just mentioned like, because I'm on the business owner, right? So if something happens to business, they're gonna sue my property, to my asset.
They can sue you, and like I said, like in companies, there's a limited asset, there's limited liability, where they go after the company first. And again, I'm not a lawyer, guys, so you need to get legal advice. Is legal advice, but I know general information on how it works. But basically, they sue the company first. But if they find that the director was negligent or has committed fraud or done something like illegally, they can go after the director as well. There are some certain laws where the director can get fined liable, personally liable, because they've done something deliberately to impact the the creditor or whoever's suing. So they can go after the director. And just because you're not liable as a director doesn't mean that people won't try to sue you anyway. Yeah. So like that's why it could cost you more money, because they know they feel like it's your fault, and they'll just they go vendetta on you and they blame you because you're the face of the company. So as a result, that they can go after your personal assets, and because even though your investment property's got nothing to do with your business or whatever private dealings you had, the only thing is that it's owned under your name. That's why they can go after you. Yeah. So that's why, as a business owner, I usually tell clients that try to find a non-risky spouse and put it under their name. Yeah, just to protect yourself. It's a bit of like a insurance for a rainy day. But everyone's situation is different, right? As you guys can see, a family trust may be applicable to you. So if you answered to me and you said to me, "Hey, I've got mum and dad, I've got my brother and sister. They don't really work. They don't have no income. They don't plan to have any income, but I can't really buy the property in their name because I have no income. But I can distribute profits to their name because they're not planning to work anymore. Maybe they're disabled or anything like that. That's where your situation changes. If you also said to me that you already have an investment property in your name, you have also another investment property in your wife's name, that means that you've already capitalized on the land tax free threshold. You've already utilized this already. Remember how I said land tax free threshold is based on total land that you own in your personal name, or in the entity. So once you utilize this, it doesn't matter. It's not per property. Once you utilize it, it's gone. So therefore, the next value, like you're going to pay the land tax of 1.6% no matter what on the next property, even you own it in your personal name. Then maybe it's better to buy in the family trust because you have the ability to distribute the profits. Also, you got to have to ask the question: is the property going to make profit? But if you were to say to me, all the individuals in your family, high income earners, there's no way I can distribute any profits, and then same conditions apply, then I'll be like, okay, company is the best way. Reason being is because 30% tax, here it's 47%, wife's 47%. mom and dad 47%. Let's just try to keep the tax as low as possible, 30% here. Let's keep all the retained profits in this trading company. And then the next goal is to reinvest into another property. Then I'm never going to take the profits anyway. Doesn't matter because I have enough to live off. So a trading company might be better. And there's no Division 7A issues. You can just lend the money from your trading company, the retained profits, over to this investment vehicle, which is a company, and then just buy property under this company and just keep reinvesting the profits to buy more. And then you stockpile all the cash. And then when you decide to retire, what would happen is your income as well as your spouse's income will probably drop. And so therefore, once your income has dropped, then you can start taking the retained profits and pay dividends from this investment property over to you. And a lot of clients that I have that are in the retirement phase are doing this. So they get like SMSF income because they're in pension mode, but they also all the pension that they receive from the SMSF is tax free. I did a deep dive about this already. So SMSF income is tax free because they retired, and then what they do is they also get like dividends from their investment company, which owns property and just has like cash just sitting there paying. They paid about 30% tax for like 10 plus years. They've got $1 million sitting in there, and they just either buy property or reinvest it or just let it sit there, and then just take a $40,000 or $80,000 dividend as well each, and they pay as little tax as possible. And the reason why they pay as little tax as possible is because if they were to take like a fully franked dividend of like grossed up to $80,000, the total tax they will pay in their personal name, what the heck? Oh, sorry. Give me a sec. Annual income is $16,000, right? But you know, when you pay a dividend, you already have a franking credit. Remember how I mentioned to you guys that if you pay $80,000 in dividends, you would have paid taxes of 30% in your company. So therefore, you actually get a refund. So you're supposed to pay 16 grand, but this calculation is actually wrong. It's probably about $20,000. But yeah, you'll probably get about $4,000 tax refund because you get a tax credit from the company taxes that you paid in your company already. And then when you pay it to your personal name, your tax rate is lower than 25%. So therefore, you get a tax refund. So this is like investment tax planning structure that they've done, and it lasts for 10, 15 years because they don't plan to ever sell the property. They receive rent. Yeah. So this is kind of like, I kind of answered pretty much your question, and I just went into the future and present as well. All right. See how guys, like when you learn all this stuff online, they only talk about this. They only really care about your discount, 50% discount, and distributing. These are the main things that the people online only talk about, and I can't stand it. Let me just highlight it for you guys. This is what they talk about: no discount, split income, and then the tax rates. But they don't talk about like you taking the money out, Division 7A issues. They don't talk about land tax issues. People forget about that. They don't talk about the ability to borrow money as well. Okay, cool. I know there's a lot of questions. So I better get started on the questions as well. Investing property via company, we can't live in that property for free. Correct. Yeah, correct. You can't. You technically can't live in the property for free. There is a downfall of investing in a company or a trust, and it's great that you asked that question, which is you get to claim main residence exemption. Okay. If you guys watch the video that I released on YouTube, if you live in the property, you can exempt the tax on that property if you ever sell it. But if you own it in your trust or your company, you lose the ability to be able to claim their main residence because a company can't live in the property and a trust cannot live in the property. So therefore, you lose the ability to claim the main residence exemption. There are like, some lawyers out there that can say that they can write some sort of like agreement in place, but I never tried it before. So it's best to speak to a tax lawyer when it comes to like trying to argue that it's your main residence, even though it's owned in an investment vehicle. I don't think it works, but some people have tried and they say it works. But To answer your question, yeah, you can't live in that property for free. You actually have to charge rent. It's an arm's length issue, in an in-house asset issue where the ATO doesn't allow you to not charge yourself rent because you know, if as long as you don't claim the tax deductions and anything like that, I don't think it's a problem. But yeah, if you don't claim any of the tax deductions and you don't charge the rent, then you're just paying for all the extra costs anyway. So yeah. Is the land tax free threshold applies to all investment properties held by an individual, or is it per, oh yeah, I already answered that question. So it's per individual, and it's like you get the land tax free threshold for each individual. You also, the funny thing is that in some states you get it for the company as well. So the company is actually treated as a individual for land tax free threshold. So you kind of get the land tax free threshold here too. So look, I think you can also get land tax free threshold here, here, and here again, and here again. Yeah, you guys get my drift? So you can kind of like get extra land tax free threshold if you own more companies. So that's why I'm a big fan of this. Big fan. Okay. And maybe I'm a big fan because it kind of fits my scenario. It fits my circumstance. I'm going to own this property for a very long time. I'm eventually going to receive rental income that's going to turn it into positively geared. It's going to be profitable. I don't want to pay the taxes in my personal name because my personal name, the taxes are quite high. I already own investment property in my personal name. So I've claimed the tax-free threshold, a land tax-free threshold. I don't have any individuals that I can distribute profits to. And also, I've got this company that's making profits and I don't want to pay a top-up tax for it to take it out. So therefore, I do tend to like this trading company a lot more than everything else. And obviously, super fund is the best, 15% tax, 10% capital gains. But the problem of SMSF is that you can't access the money until you retire, which is a very long time for me. I'm 18 years old. No, I'm just joking. I'm 34, but I I like that's still a long time. That's like what 25, 30 years. And I don't have enough money in my SMSF. And it's like there's only so much you can put into your super fund. I thought you mentioned earlier that a company doesn't get land tax free threshold. No, I said that the trust doesn't get the land tax free threshold. So if you go into here, land tax for companies. Yeah, let's search this up. So for land tax purposes, the company includes all bodies and companies receive the benefit of the land tax threshold. Okay, you have to look at it in every state. Every state is very different, but sometimes you get it like for some states, I can't remember which state, that a company and a trust have a premium, and they do get the land tax free threshold. But I have to admit though, New South Wales is the one I look at because I'm a bit biased. I live in New South Wales, but yeah, I have to say some states penalize owning property in a family trust. Yeah, in that state, and or they penalize by not giving the threshold or charging a higher rate of the land tax rate. So one thing I have also always have to ask is which state are you buying the property in as well, because that's important. I think that kind of answers all the different types of structures and how that all works. I guess I want to go about like different strategies you should think about. So this is just to jog your memory, get you to think about things so you can ask the right question when it comes to your accountant. And most of you have the accountant that is me, so it just gets you to start thinking about these things so you can then tell me about the situation, and then I can give you the advice or confirm what you think is right or not in terms of the structuring. So the first thing you need to think about when you're buying a property is it positively geared or negatively geared? So what that means is are you going to make a profit on the rental income, or are you going to make a loss on the rental income? And what I mean by that is not the repayment of the loan, because the repayment of the loan is they see it as an expense, but repayment of loan also includes principal. So the principal amount is the loan repayment that you're making on the loans that you borrow. So say that you borrow $1 million to purchase the property, you have to pay that $1 million back in the next 30 years. That portion of that payment to the $1 million is not tax deductible. You shouldn't be expensing that and treating it as negative geared because you don't actually get a tax deduction on that loan repayment. It's the interest that you get to claim. So a quick way to work that out is if your rental income per week is let's say $800, and then times that by 52, that's like the how much income that you're getting. And then I look at your interest, and usually say that your interest is 6%, and the 6% of the $1 million loan, and that's 60 grand. So that means that right now you'll be negatively geared because you're only receiving rental income of $800 times 52, and your interest for the whole year is 6% times $1 million. If the property was actually worth less, and it's $48,000, you can see that you're still negative geared. It's only when like you borrowed 500K and you've and the rental income is bringing you $800 a week, and then that's where this is positive geared. Obviously, there's other expenses. There's council rates, water rates. There's real estate agent fees and repairs and maintenance and all that stuff like that. But the biggest chunk of expense is usually the interest, and everything else could be like 5 to 10K more. In this case here, it's still positively geared as a result of that. So that's what being negative geared and positive geared, and it's important to know. The reason why it's important to know is that if it's negatively geared, like the situation where I said that it was 1 mil, then keeping it in a company in a trust is not beneficial for you because you could just own it in your personal name and then claim that against your high tax taxable income because you're paying 47% tax. So you could actually get a benefit of claiming this loss against your income. That's why it's very good to understand if it's negatively geared or positively geared. Next thing is also understanding like depreciation. A lot of people don't actually understand depreciation and what it is. And the best way to explain depreciation is basically if you purchase a property for $1 million, on that property, the land value may not be worth 1 mil. Land value might be worth 800K, like which is 80% of it. And then the other $200,000 is the building costs. And the ATO sees that the building cost is actually depreciable. You can depreciate the building cost because it's something that will wear and tear. And so you can claim that depreciation against your rental profits. So that's how depreciation works. Obviously, the depreciation can't be claimed like upfront. You had to divide it by like, I think it was like 0.25%. So you get to claim $5,000 a year. But then that helps you push your positively geared property into negative geared without paying extra on top per year. So it's something that's great for property investors to be able to like claim a bit more back in taxes. But does it sway the investment structure? Not really. Like it doesn't change the investment structure advice. It just just something that to raise to you because it's actually important for property investors. Okay, another thing is what I've raised already is the 50% discount. It's important to understand the 50% discount because companies don't get the 50% discount. I still prefer a company even though it doesn't give you the 50% discount. Does anyone know why? No? Because I created a good looking, I created something for you guys last night. I just want to show you guys something. All right, I've vetted it with my wife as well because my wife's an accountant and she's really good with this stuff. So let me just show you guys something. And I don't think I've ever seen any accountant ever show anyone this. If you have, let me know because I want to be that person's friend. Okay, let's just say that the business owner had $1 million profit that they want to take out of the company. So Box Advisory Services in the last 8 years has made $1 million. And it's like, all right, I've paid the taxes of $1 million and I paid 25% tax on that. So now the leftover amount is $1 million. So I made about like 1.2 or 1.3 mil. All right. And then I paid the tax on it. And then after that, I've got $1 million that I want to draw out of my company. I want to borrow out of my company, and then purchase an asset, because now it's time to diversify. Okay, so if I were to take that money out, put it into a trust or in my personal name or individual, I would actually have to pay taxes on that. And the tax I will need to pay is 45%. Okay, so let's just assume that I haven't paid the tax. Okay, I've done the formula in the way that I haven't paid the tax in the company yet. So say that I made a retained profits of 1 mil, and I didn't pay the tax on 25% yet. But if I pay the 25% tax on that, it will go to this, like 250K. Then I also have to pay the extra 20% top up tax, because in the individual name, I will get taxed again, right? If I were to take the dividend now, this is the company tax, and this is the individual tax. So altogether, that adds up to 450, and 450 tax means that I'll be left over with $550, right? Cash to invest in the company, $750,000, because I only need to pay the company tax was 250K, and then I'll be left with 750. Okay, so my argument is that when you come to invest, when you take that money out of the company, the benefit of having a company, using the company, is not, we shouldn't worry about the benefit for the future, which is the 50% discount, the ability to split income. We should worry about how much money we actually start off with, what the present situation is. How do I get more out of the retained profits, the investments I have, which is, if I were to pay as little tax possible at early stages, I could actually make a lot more money. Okay, so let's just say that from that 550, I invested it all. This is the argument that I didn't get a loan. Let's just say that I never got a loan for this, because it doesn't matter about loans. It's not about the situation about loan. It's about just how much money do you start off with. So let's just say I bought a property for 550. If I bought a property for 550 and the growth rate was 8% per year, and rental profits will be taxed at 30% per year for both the trust and company, it doesn't matter. So I'm taking, these are the assumptions that for the company and trust, I don't really care too much about the rental profits. It's always going to be taxed the same, because if in the trust, you can distribute the profits into a company, and from a company, you still get taxed at 30%. And the growth rate is at 8% per year. I've done two scenarios. First scenario is the land keeps going up, but I only invested 550. But the beauty of having a trust is that at the end of the day, the net profit that I make, which is the after 10 years, I decide to sell, 1.1 mil minus 550K equates to about 550K in profits. 550K in taxes is, you get to be taxed at a very low tax rate, because you get the 23% tax rate, because it's 45% normally, divided by 2 because of the 50% discount. You end up paying $123,000 in taxes, and then your net profit is 425. Whereas in this situation, your investment is higher because you paid lower tax, because you lent the money from your trading company to another company, so you didn't have to pay the top-up tax, but you got more extra cash to play with, and then you invest it. Same situation, same assumptions, but the only change is that you started off with more money because you didn't get taxed more. Look at the difference. Your net profit is 750K because you invested more money to purchase a property, because you didn't think about the exit strategy. You thought about how do I get the more money to purchase a higher asset? And I remember mom and dad used to always say this, because I used to drive past this house in my street, and they say, if I bought this property, if I had extra money, bought this property here instead of the current one that we're living in, we'll be more well off. We'll be so much more richer now, because this property is worth $1 million worth more than this property. But they were like, and I was like, why didn't you? They were like, couldn't afford it. That's the reason why. They always say that. I think everyone's heard this term before. I think all our parents do that. Or not even just our parents, but friends, and everyone says that. And that's where you don't sometimes make decisions based on the tax savings you're making in the future, but you make decisions based on the profit that you're going to make. So I would consider buying in a company, because I can use more money. I can borrow more money, or I can take more money out of the company, and pay a lower tax rate, and so therefore my purchasing power is stronger. So as a result, my net profit is higher at the end of the day because the growth rate of 8% compounded on the starting a capital being higher will result to a higher net profit. So even if I pay a higher tax rate of 30%, my end result will be my profit will be higher. That I would still make more money no matter what. It doesn't matter about the taxes if I end up paying a lower tax rate in a trust or if I pay a higher tax rate in the company. I would still be netting off more value if I were to invest in the company. Okay, so that's the difference. And something I've never seen accountants explain really well. Some buyer's agents explain it really well. I've seen it happen before. So let me just summarize this. If I were to buy an investment property, take that money out from my company, pay 25% tax, that means that my net investment that I have to invest, my capital, I'll be able to invest more. So I'll be able to buy a property at a higher value and start off with a investment with a higher value because I pay less tax earlier. And as a result, my tax, yes, is going to be higher as a result from a company because it's got a 30% tax, whereas a trust gets a 50% discount, so the tax is lower. But in the end, I make more money investing using a company than a trust. That's the big difference. The power of companies having a lower tax rate and not having Division 7A issues. That's why I ultimately believe that if you're in my situation and you fit my situation where I have high income earners in my family, I have a company that has a lot of retained profits and I want to invest, and I can't find another individual to invest in, and I've utilized my land tax free threshold, a company is a better structure for me. Yeah, because I can start off with a higher investment. And some people would say to me, well, Davey, it doesn't make sense because like I'm not going to use 550 to purchase. I'm going to borrow money. So my deposit's going to actually be less. I think personally, it's going to be the same thing, because it's not about the borrowing that's the problem. It's about you paying too much tax at the start. So if you were to invest using a trust name, it's the same result. Like in order for you to get the deposit, you will pay, you would still need to pay a higher tax bracket to get the money out of your company name to put it down into a trust for a deposit. You'll pay 45%, whereas in your company name, you can just borrow it from your company and pay that 25% only, and then have 150 grand for a deposit rather than 110. Yeah, and your borrowing capacity is higher because you pay less taxes in your company rather than in your personal name. Last thing is that I kind of want to mention to you guys that if you ever invest and you're planning to knock down, rebuild, and sell, it's very, very confusing. And I don't recommend you trying to figure it out on your own. But when you do, like, I do have feasibility analysis on like buying a property to knock down and rebuild. So it's actually very complicated and there's a lot of expenses included. And so I can quickly show you guys that if you purchase a property for 1.5 mil and then you knocked it down, rebuild it, and spent another 1.5 million to build a duplex and you sell it for 2 mil on each side, automatically people think that, wow, I'm going to make so much money. But they don't realize that there's so much cost involved and so much taxes. So you would have to pay 100K in GST because you're knocking down and rebuilding and building a property. So therefore it's a business. And then you're left over with profit of 900K, but then it gets eaten up by interest because you've held the property for a year or 2 years. So this is only 1 year calculation. So this is 6%. Oh, well, I did 8% because it's a higher risk for the banks, but 8% on the cost of land, 8% on the construction. And I've only done, that, and that's on just basically borrowings of construction. And then also council rates and all that stuff like that. Obviously, this calculation can change depending on how much you're borrowing, how much capital you're putting in. But yes, then you had all these other expenses in terms of like selling fees, land tax, because you held the property for more than 12 months. So you had to pay land tax and stamp duty, and then designs, architect fees, and then DA and all that stuff like that. The total cost after production is construction is another 500K on top. So as a result, your net profit's 320, and then you pay income tax for that. So you end up with 240K from what you thought of making $1 million. And sometimes it's like, is it worth the risk? Because if you make one mistake, where if the construction blows out by extra 100K or 200K, then really, did you even make any profit? Yeah, it's absolutely crazy with property development. That's why a lot of people have been saying right now is that it's not worth actually building. And a lot of people are going bust right now. It's because what's happening is the construction cost is going up. These costs are also going up. The interest rates have gone up. So people go calculating on like 5%, or 4%, and now, 4%. But now, if let's say interest rates go up to 10%, like it's going to affect this severely. It's going to change everything. So that's why it's high risk. And if this just bumped up by another like 800K, or not even another 200K, 700, because of extra costs, because they found asbestos in the build, and then it's going to cost you an extra 100, 200 grand, and then your net profit's only like $50,000. You're pretty much breaking even. Yeah. It's quite risky. So be careful with property builds. Make sure you speak to an accountant. A lot of people try to do it on their own, and it kind of messes them up. Yeah. Yeah, so pretty much that's it, guys. That's what you should think about when it comes to buying a property.
I have one more question, sorry.
Yeah, sure.
About the capital gain. So let's say if I bought the property, I'll leave it there for a couple of years, right? For example, 5 years, and then I move out. I bought another new property, and then I'll start using that as my primary property,
Yeah.
right?
Yeah.
And then let's say in the future, I want to sell my other property. How do I work out with the capital gain? Because I didn't have any record like since I moved out, like how much that value cost us, how much value that property before I move out. How do I calculate?
Yeah. Brian, you didn't watch my my video last week, did you?
I know that about the sixth rule, but it's a bit, not quite sure. Is it that?
Yeah. So let me just draw this out for you. So let's explain it well to everyone, because it's actually a very common question. So say that year one, you purchased it and then lived in it. And then let's say you lived in it to year four. Year four, you moved out, and then purchased second property. Is that right? And then you lived in the second property. And then say year 8, you sold the first property. You got two choices. I'll give you the first choice first. So if you lived in it from year 1 to year 4, from year 1 to year 4, it's your main residence, so you get an exemption. If you sold it from here on, it's excluded from tax. Okay. If you decided to have a second property after it, what would happen is then you got to get a valuation on the first property. Okay. Once you get the valuation on the first property, market value, you don't have to do it straight away. You can go and get it later when you decide to sell. They can backdate it. They can figure it out because they look at like the history of other properties getting sold. And say that you bought this for 500K when you first lived in it, and then now you've the valuation now is at 1 mil. Okay, 1 mil means that it's made a profit of 500K. And then in year 8, it's worth 1.5, not 1.5, let's just say $2 million. Just say it's gone up like crazy. All right, oh, not that much. But what would happen is, some people might think, oh, it's 2 mil minus 500K. What the formula is all the way from here to here, it's your main residence, so it's exempt. But if you decide to have a second property, you do a valuation on it, and this becomes your cost base. This 1 mil, when the time you moved out and it stops being your main residence, it's taken as if you've purchased it at that price. So that now becomes your cost base. So if you ever sell it at the next, like later on down the track, you can go that minus this, and that's your net profit, and that's your capital gain. You still get the 50% discount because you own it for more than 12 months. And so it's 500K, and then you pay taxes on that. say you're on the 47% tax, it's 235. Cool. So that's option 1. Option 2, even though you live in this property, you can argue that this property is not your main residence. You want to still choose this property to be your main residence, even if you moved out. And there's that 6-year rule. Remember that video that I did? Okay. But the problem of doing that, though, is that you lose the ability to claim main residence on the second property if you ever sell it one day. Okay. So if you claim main residence in this, you can actually technically say that from year 1 to year 4 to year 8, because it's within 6 years, this is still my main residence because I lived in it previously. You can argue that, and the ATO will accept it. And then as a result, there will be no tax. You won't pay the tax in here. However, your second property would then be taxable when you decide to sell. And that's usually a problem where most people don't accept. Yeah, that's how that works.
Makes sense. Thanks.
No problems. All right, I think that is it. Well, I love you all, and have a good day.